So the big question really is whether they can sell them because, Peerstreet, I mean, again, I'm kind of assuming things, but I think they're easy to assume. Peerstreet wants to sell these loans off so it can wrap this bankruptcy up and either liquidate the company or kind of bring the company forward, without all of this debt so that they can try again. And they want to, I mean, there's like a chapter 11 versus chapter 7 thing there. We don't need to go into the details, but the people who own the notes, most of them, they want, the notes they want essentially someone else to take over the loan, take over servicing the loan, and continue to pay them out through the term of the loan. Mm-hmm. The reason being is, it's not a great time to sell loans at all. So when you're selling, if you're selling these products, especially with the interest rates as low as they probably are compared to what interest rates are now, they're going to be valued, maybe not pennies on the dollar, but, some amount of coins on the dollar for sure.
Hi, Adam Gower here, founder of Gower Crowd and host of the Real Estate Reality Show at youtube.com/Gower Crowd and on podcasts everywhere. Thank you so much for joining me today. My guest today is Alex Nicoll, who is a reporter at Insider. And he penned an article earlier this month, September 2023, titled Real Estate Crowdfunding is a House of Cards. Well, how could I resist but to give him a call, as real estate crowdfunding is my lifeblood these days? How could I resist but to give him a call and ask him more about what he had, what he was writing about, what he discovered, what he was talking about, the background to the article, which, of course, by the way, was all about the Peerstreet bankruptcy that emerged over the last few weeks. Well, what you're going to learn today from Alex is how he did his research on that bankruptcy, the kind of documents that he looked at, the people that he spoke to. He shares some insights into what he discovered and his thoughts about real estate crowdfunding. And he's a very nice fellow. He does, in fact, he didn't actually say it in the podcast, but ahead of our recorded conversation, he did say he didn't want to paint a brush across the entire industry, but just to identify this particular failing. You're going to learn more about what the business model of Peerstreet was, how they raised venture capital and how much venture capital they did actually raise to put the business plan together. It is a mind-boggling number. And we also discuss the various factors that have impacted this particular niche in commercial real estate crowdfunding, which is actually the single family home fix and flip market, and the factors that have driven Peerstreet to their unfortunate demise. If you want to learn more about Alex and if you want to read the article directly, just go to gowercrowd.com to the podcast page, where I will include links to the article, to Alex, to his LinkedIn profile, to Insider, etc., and where you can subscribe to our newsletter if you're not already done so. It goes out every Wednesday. We cover the world of real estate investments real estate crowdfunding and syndication with all the latest headlines and some commentary. And usually there's some pretty cool educational stuff there as well to keep you at the forefront of this industry and of your investment decisions. All right, let's move on to my conversation with Alex Nicoll, reporter at Insider. Very interesting conversation. Here he is. Let's get going. Alex, thank you so much for joining me today. It's a real pleasure to have you, and I'm really grateful to you for having sought permission, I guess is the right word, from your employer. You are a journalist or reporter, I should say, with Business Insider, and you wrote an extremely interesting article that piqued my interest. The title was Real Estate Crowdfunding is a House of Cards. Oh my goodness. It's also it's my entire life. So that's why it piqued my interest. But why don't you tell me a little bit about what that article was about? Why don't we start right at the very top? It was about Peerstreet. Tell me kind of the highlights. What was it about? How did you come to this conclusion that crowdfunding is a house of cards.
Thank you so much for having me, Adam. Really appreciate you bringing me on. Yeah, so this article, I'll let you in on a secret of the industry. We often go with the most eye-catching of headlines. So I will say that. I think the article is maybe a bit more nuanced than that headline might say, and I think it does lead some, I definitely would not argue that the entire industry is that by any means. But so I guess to take a step back, I've covered crowdfunding kind of, passively. I cover real estate and real estate technology here at Insider. I've been doing that for 4 years. And, I guess within the world of prop tech, I have been hearing about, crowdfunding and covering it occasionally, but from a pretty shallow perspective. Frankly, a lot of it is X company raised Y amount of money from Z venture fund, and they want to sell you a piece of real estate this way or that way, and not really digging into the specifics. But, an editor of mine had flagged Peerstreet's bankruptcy. And as you might imagine, us in the financial media world, we often are very interested if Michael Burry is attached to something. So Michael Burry's kind of endorsement and Andreessen's investment in Peerstreet kind of made Peerstreet one of the bigger, one of the crowdfunding companies that would maybe get a bit more attention.
Okay, so just pause there, because there's one guy who doesn't know who Michael Burry is. Who is Michael Burry? Just tell that one guy who doesn't know who he is.
So Michael Burry is basically, the best way to probably explain it is that he is the hero, quote unquote, of The Big Short, the movie and the book. But basically, he was one of the early people in kind of with the GFC who kind of realized, wow, these mortgages are not what we think they are. These bundled up derivatives with bundled up mortgages are not what we think they are, and I'm going to short them. And he made a lot of money. That's the titular Big Short. I mean, there are other people who shorted in that movie and in that book, but he has made a name for himself. That trade made him very famous. I mean, I believe to the point where you don't normally see people that run a hedge fund getting profiles in places like Vanity Fair. I think Vanity Fair. I could be wrong. It might be another lifestyle magazine, but so he's one of those names that attracts a lot of interest for people in the media for sure. And it's kind of, for example, basically whenever he says something about the market, you're going to see every investing website write about it in one way or the other, including Insider. So that's Michael Burry. But, we had heard Peerstreet declared bankruptcy, and covering bankruptcy is interesting because it could either give you a lot of, I guess two things. Very dense, very complicated, lots of documents. That kind of makes it challenging. But there's also lots of documents, which as a reporter is really fascinating. You can kind of see inside of a company. And, my editor had flagged it. We were thinking about maybe doing a quick turnaround story, basically reading the bankruptcy documents and doing a story. And a couple of things piqued our interest, which was that, the level of kind of loans that were, frankly, to be sure about it, that were in default of some level, was 54%, which is just an outrageously high number. And
again, I hate to do this to you because you do know everything about the article that you wrote, but let's step back just
let's take a step back.
Who were Peerstreet? What were they doing?
Yes.
Let's start with that. Like when you talk about loan default, what were they doing? What was their business model?
So Peerstreet was a real estate crowdfunding platform, and specifically what they would do is they would purchase, or I believe sometimes originate as well, residential mortgages. And these mortgages were oftentimes mortgages being used by investors. So, you think a fix and flip investor is probably one of the main customers. But they would take these mortgages, and then what they would do is they would cut them up into notes. And regular, accredited investors, so not every investor, but people over a certain threshold, which I imagine most of your listeners might be aware of what that means. Those investors could then purchase a note that acted as if it was a fraction of that mortgage. So, what they would, essentially it's a way for small time investors who maybe can't, own, would not be able to lend, the $300,000 for investment property somewhere, could purchase $10,000 worth of that mortgage and therefore get, over, let's say it's a 5-year term, you get, a 3% return, a 6% return, whatever the return is on that mortgage, and kind of take in a lot of ways the same risk and reward that you get, that a bigger investor would get, but just at a smaller scale.
So do you mind if I chip in with some of my knowledge?
Please do.
Please do. Just to kind of add some layers to it, because it is really interesting. So as I actually interviewed Brew Johnson, who was the founder of Peerstreet, for my podcast some time ago. In fact, I think he's even in one of my books that was published some time ago. And as I recall, what Peerstreet did was they bought they kind of created a secondary market for hard money lenders. So these hard money lenders would be able to finance fix and flippers who needed to buy a house that they wanted to flip. And that's actually something we should roll into towards the end anyway, the housing market, because it's actually very interesting. So fix and flippers couldn't go to a bank who wouldn't turn around quickly enough. Maybe they didn't have the credit, they didn't have the speed, etc. So fix and flippers would go to a hard money lender, somebody who would lend a significantly higher interest rate. Maybe, again, I remember at the very beginning, I think their terms were, you got 12% interest. And then as the market got hotter, it kind of came down and down. They would buy those loans from hard money lenders, take them off the hard money lenders' books, and then exactly what you said, then they would crowdfund pieces of that to accredited investors for yield. All right, go on.
Yeah. So no, I think that's great context. And yeah, so these investments are, they can be somewhat risky. I think we all kind of know fix and flipping is somewhat of a risky industry to some extent. And basically what had happened was the company kind of grew pretty steadily through the 2010s, and then really kind of, exploded, as many residential related companies did. And also crowdfunding companies of all sorts did, in kind of this, I would say the pandemic years, the early, the first couple of years of the 2020s. And, which is wild to be calling it the 2020s at this point, but I guess, we're almost into the 4th year of it now. But, anyways, but what had happened was, as the housing market, as interest rates went up, the housing market slowed down. They started to have a lot of these loans not perform for many different reasons, I'm sure. And simultaneously, demand basically dried up, because I get a couple things. One is that, there's not that many of these transactions happening. So there's not many kind of mortgages to back. There's not that many, or hard money, there's not as much hard money lending going on that they could then cut up into notes. And then simultaneously for the investors, when you can buy treasury bonds, or when you can buy much more secure investments that will give you a return of like 6%, that's pretty much guaranteed. This level of risk doesn't really make sense. And essentially the company started to contract pretty quickly in 2022, was already, we know this in the bankruptcy documents, already heading that way. And then by 2023, in the beginning of July, I believe, they filed bankruptcy. And so to go back to the overview of the story, it's a lot of context, but I think you need it there. As I dug in more, I started to realize that there were a couple things that I had heard in the past from critics of crowdfunding that really applied directly to what happened at Peerstreet. One of them is that crowdfunding can, at times, attract a maybe subpar or riskier product. And, we can go into the specifics there, and obviously a lot of caveats to that. And also, frankly, being, what we do at Insider and a lot of the large publications is we really focus a lot of our coverage on institutional investment and institutional grade investment. So everything looks like a bad investment compared to what institutional investors are pouring their money into. Right. But just,
but this one had the stamp of approval of Mike Burry, right? So
for sure.
Plus, Right, and they also right. So actually, they raised a lot of venture capital, didn't they? So how much did they raise, and who did they raise it from? That kind of stamped
Yes.
approval they were doing.
So 121.9 million is the number that we have. And that was, the biggest kind of name there was Andreessen Horowitz, which is, or A167, they're called now sometimes as well. They're one of the biggest Silicon Valley investors. I mean, I don't even need to list the name. They've invested in so many early stage companies, and have really become one of the kind of kingmakers of Silicon Valley, I would say. And so they had a lot of institutional level or big name level support that was really backing them. And so what really caught my eye though, so that was interesting, and the concerns about the level of investments that they provide was interesting. But what really attracted me was suddenly in this Peerstreet investment, in the case, the bankruptcy case, investors started throwing letters in, basically sending letters to the judge saying, I thought that, basically saying like, protect my investment. And what it started to come out through court filings was that Peerstreet, a lot of these investors had thought, because of marketing purposes and how, certain kind of how crowdfunding can be talked about. And again, there's differences here that we can get into, but they thought they were getting a fraction of a mortgage. They were purchasing a literal fraction of a mortgage that is secured to that mortgage, that they have rights, they would have rights as if they basically owned a really small mortgage, a really small
so that's the key term, isn't it? They believe they have an ownership right of some sort.
Exactly. And they didn't, at least according to Peerstreet's documents. And if you read through kind of their, the agreements that they sign when they invest, it's pretty clear that it's an unsecured investment. But a lot of these investors really thought that it was either, if they saw that it wasn't secured, they still thought that they had a level of kind of ownership control that, the company was now arguing that they didn't. And kind of, it's created this kind of, I mean, I haven't really seen this in many bankruptcy cases before. It's a huge amount of letters coming in. I mean, there was over 50 at the time of the article. There's been probably at least a dozen since, from all of these investors who, again, they're accredited investors. Obviously, the bar for entry is much higher than it is for, the traditional stock market. So a fair amount of people with a fair amount of financial knowledge, right, feeling like they got duped. And that was really what attracted me. And then at the same time, and we could talk about this as well, there's been a lot of kind of noise in the real estate crowdfunding world, generally with other issues. I'm sure you've probably spoken about CrowdStreet. Actually, I know you have. I've listened to a podcast you did talking about this, about CrowdStreet's kind of now infamous deal with Nightingale. There's been kind of increasing SEC, or maybe not increasing, but there's been a fair amount of SEC enforcement actions and interest into the space. Mm-hmm. And, I know that also another company that gets a lot of attention for being real estate crowdfunding, Fundrise, actually hasn't really done that model in much more than 5 years, 7, 8 years, something like that. And so kind of what I came to with this story was that Peerstreet is kind of an example of a lot of the things that I had heard crowdfunding critics talk about, and see that kind of coming true. People, the quality of investments can be lower than, a REIT would get, for example, a public REIT or other kind of maybe safer investment types. B, these are really complicated financial instruments, and it can be really hard to understand what you're actually buying versus what you might think you're buying. And see that, there's some challenging levels of kind of controls here and interest involved. And I think, there's a lot of, maybe, and I don't want to say this absolutely, but maybe, for example, venture capital money is kind of maybe the incentives of venture capital money are kind of opposed almost, at a principles level to creating a stable and functional business, especially in this space. So
It's interesting that you say that. I'm just going to interrupt briefly, and you
Yeah.
probably see the light flashing on my face from my screen. I'm paying attention. I'm just double checking. I actually spoke to Alex Rampell, who was one of the partners at Andreessen Horowitz, and it was one of the earliest podcasts that I did to talk to him. And I don't recall if it was about Peerstreet. It may well have been when I saw that they had invested. It's a few years ago. To talk to him about what they saw in the industry and why they were interested in this new type of industry. And then the other big failure that happened a long time ago in crowdfunding was Realty Shares, Nav Athwal's shop. And they were also venture backed. And you make this very good point. And it's actually a point that I've also written about, as an amateur writer as well, sitting next to a pro like you. But I also wrote about after Realty Shares collapsed, was that exactly this point that you make is that venture capital is looking for, I hate to say it this way, I'm going to use a kind of a real estate term. They're looking for a quick flip in the sense that they want to put money in now and see, 100x very quickly. They want to see a unicorn turning around. And that is anathema to successful real estate investing, which requires really a long-term perspective. So there is this conflict, isn't there? To what extent do you think that drove, I don't know if you got so deep into this, but I noticed you've read hundreds of court filings, lucky you. But so to what extent do you think that might have driven decision-making inside Peerstreet that caused their underwriting to maybe, it's almost coming back to Mike Burry, this idea that the capital that is driving the market is driving it in such a way and creating these incentives along the line that it's creating misalignments of interest and essentially sloppy work, along the way that balloons and then implodes.
So unfortunately, in those case filings, and in my reporting, I wasn't able to get down to the core question there. I think it's, but I guess what I can say is a couple things. I think one, this is a theme I've kind of explored a lot in my work. I've covered, I have been covering, when I first was hired, I was actually hired to cover just real estate technology. And then my kind of, my beat has expanded to commercial real estate generally, and even residential sometimes. But, in real estate technology, I guess I'll say I can talk from my own personal experience. My trial by fire as a reporter was helping to cover WeWork's IPO implosion. And I think that is maybe the most famous example of, venture capital creating this grow at all cost mindset that, because there's always more money to be poured into these companies, if they're able to show growth, they don't really need to think about the balance sheet as much as they need to think about, continuing to grow and grow and grow and grow. And so that obviously WeWork is, probably the most extreme example of that. But, that was kind of my introduction to this industry. And I've continued to cover, similar themes in, I covered Better Mortgage a lot, which is another company that, has, had a huge amount of investment from a really big name investor and grew really big and then had huge losses. Or in the fix and flip world on maybe a smaller level, Sunday is another company that I've covered that grew really quickly and then contracted really quickly. And I think while I can't say absolutely that's what happened here at Peerstreet, I think it's hard to, there's enough circumstantial evidence that you can definitely put these things next to each other. And it just seems like, again, venture capital really requires like these really massive returns that, have been possible in the past for true software companies or for social networks but even let's say like an Uber or something, which is, worldwide. I mean, I guess it's kind of not worldwide anymore because I know some countries have kicked it out, but regardless, this kind of worldwide name that's almost become shorthand for an entire class of companies, really. Uber for this, Uber for that, grew so fast, massive, but has not really been able to actually create a profitable long-term company and has a lot of turmoil. And I think I don't want to like cast aspersions on all of venture capital, and I think investors are, they are trying to do their best to provide a good return for their shareholders. And, there's a reason that they invest that way, because when you do hit it big, boy, you hit it big, 100x returns. That is, that's your entire fund right there, even if you made 20 investments.
Right.
But
what you discovered at Peerstreet for all these loans that they were bringing on board, and you started to talk about it right at the beginning, before, of course, I cut you off so rudely, but let's get back to it. So what did you find out about the quality of the loans that they were taking on board? And obviously this was, well, tell me what you discovered and how this led to their bankruptcy.
Yeah. So what I discovered was that, at the time of bankruptcy, 54% of them were in default or non-payment for more than 30 days, which is just a massive number. I mean, I spoke to a fair amount of experts, and, people knew it was going to be bad. People were falling to bankruptcy, but not that closely, and when I quoted that number, I got like multiple kind of gasps and wows. Right. Oh my goodness, that's really poor performance. Now, I think there's a couple things going on there. I mean, there's the kind of general market is just not great. It's not I think we've all seen the headlines everywhere. It's a really hard time to be investing into real estate. Rents are slowing, the housing market is slowing. And at the same time, capital costs are doubling, tripling, et cetera, depending. So it's a hard time, but regardless, they really were not performing very well at all. What's kind of funny, and I didn't include it in the story, but a lot of the investors I spoke to were like, I know it's not performing well, but most of my loans are performing. They felt that they had picked the right one still, which is kind of an interesting, and maybe we could talk about this, be like, almost like the pop psychology of real estate crowdfunding, of kind of this feeling of being able to, I can be the one that can pick the right choices. I can do the research and figure it out, which, can be true. I'm not saying that's not possible. But yeah, I mean, in the end, if the loans aren't performing, sure, you can foreclose on them and eventually get some sort of money out of it, but that takes a lot of time. Mm-hmm. And when you have more than half of your loans not performing, you don't have the money coming in to pay your bills. The other thing I'll note too, and I don't know this for sure because it's not in the bankruptcy documents, but I can imagine, is that as things were kind of falling apart at Peerstreet, I wouldn't be surprised if they sold off some of their highest performing loans to try to kind of buoy the company and bring in some capital, because, notably, they weren't able to raise any more venture capital funds. So that's an important thing to note with venture capital.
When did that stop, Alex? Do you know? 120. It's just, to me, it's mind blowing. If somebody gave me 120 million, I'd have a really hard time losing it. I imagine. I mean, maybe not. Depends. When you're driven by the money that invests with you, it's a whole different story, I suppose.
I really don't know. I mean, I think the best that I know is that in the documents, they, by mid last year, realized there was a pretty serious issue, and that, I'll say something again. I think this got cut out of the story, but it's interesting.
Sure.
A former employee that I spoke with, I only spoke with one, but the story was more about the people who invested on the platform than the internal operations of the company. But I spoke to a former employee, and one of the things that they said was like, they were hired on, when the company was really growing quickly, and very soon after they were hired on, hiring freezes started, and they were worried, but not that worried. They were like, we'll see what happens. And then they started to hear kind of words that, if you didn't know startups, you might not think are bad words, but if you do, it's a really bad sign. The founders started being very transparent about trying to find more funding, and that they were searching for more funding, and kind of gave updates along the way. Like, let's say this, if you work at a company and a founder tells you, hey, we just closed this venture round and let's all celebrate, this is amazing, that's probably good or at least neutral news for you. Mm-hmm. If they're telling you, hey, we're having all of these conversations right now and we're doing our best to try to get funding and we're having these productive conversations, that level of transparency is maybe not such a great thing, because usually you're only really told about funding once it actually comes in, unless you're a higher echelon employee.
Right, and
So
the
it
underlying
definitely looks
message
like
is we've run out of money and we're looking for more.
we need a runway. Our
Mm.
runway is shortened, and we need something to kind of buoy us.
Hmm.
And so that employee knew there was an issue then, and actually got laid off shortly afterwards. And obviously, clearly there was an issue, and the company continued to do layoffs for the rest of the year. So I think, like a lot of people, though, last year, interest rates rose at kind of like a maybe not an all-time record pace, but up there. And I think a lot of people expected interest rates to rise. No one expected things to stay in the pandemic era forever, but no one really expected it as quickly as it did. And I think it really just hit the quality of the loans and hit their ability to get that money in at the same time.
Well, look, so do you mind if we kind of step beyond the article a little bit and just chat about the
Sure.
markets in general? I presume you track this fairly closely. I have some ideas and some insights to share with you that I imagine had some impact, but I'd be interested in hearing your opinion as well. Before we do, though, I'm trying to see, when was this article published? It wasn't that long ago, was it? I'm trying to see the date
It
of
was
publication.
September
Yeah,
14th.
it was earlier this month. It's only a couple of weeks old, this article. And so we're now here right at the end of September. So a couple of weeks, now 2023, just to be clear on the date stamping our conversation. Have you been tracking it? Have you continued to track it? Are there any other updates on what's going on, particularly with the bankruptcy and this question of who owns the loans, and whether or not, actually the big question is whether or not they can actually sell the loans to recoup capital, right? That's really the big question that's pending, isn't it?
Exactly. Yeah. So the big question really is whether they can sell them, because, Peerstreet, I mean, again, I'm kind of assuming things, but I think they're easy to assume. Peerstreet wants to sell these loans off so it can wrap this bankruptcy up and either liquidate the company or kind of bring the company forward, without all of this debt so that they can try again. And they want to, I mean, there's like a chapter 11 versus chapter 7 thing there. We don't need to go into the details, but the people who own the notes, most of them, they want, the notes they want essentially someone else to take over the loan, take over servicing the loan, and continue to pay them out through the term of the loan.
Mm-hmm.
The reason being is, it's not a great time to sell loans at all. So when you're selling, if you're selling these products, especially with the interest rates as low as they probably are compared to what interest rates are now, they're going to be valued, maybe not pennies on the dollar, but some amount of coins on the dollar for sure. Versus, let's say it's a 4% return. It's not an amazing return in this market, but if you hold it for 2 years and you get your 4%, you get your money back and more.
Right.
And so basically what has happened since, and there will be updates later this week, but I mean, depending, obviously court cases can change, but is that the committee of investors is essentially the company may be withdrawing its motion to sell these loans. They may have actually, investors may have stopped them from selling the loans. We'll have to see what happens, but there's kind of some chatter about that. I don't have the specifics up in front of me, so I don't want to say exactly, what has happened, but basically that the committee of investors is kind of working on a new proposal with the company, and we'll see what happens. I will say the judge seemed pretty skeptical of Peerstreet selling these loans. So what was interesting, I was kind of maybe surprised to see that, just having read the legal documents. But yeah, we'll see more. I think for a lot of the investors, they were really, a lot of these people, pretty much all of them that I spoke to, have invested in many of these different crowdfunding websites. So one of them even, within real estate and beyond, one of them invested in a company I'd never heard of that does Scotch crowdfunding. So you actually crowdfund a barrel of Scotch or of whiskey at certain points, and you wait your 13 years or 18 years, and I mean, I'm sure you get quite a return on that, long hold period. But a lot of these investors were like, I want to continue crowdfunding. I believe in it. I really think there's a need for it. And I think it's, as an investor, I really like the product. But if I find out that I don't actually, that companies can just go off and sell the things that I think that I own,
Yeah.
that might give me pause in the future. So maybe they'll, it looks like things could end up actually working out for these investors, and that could actually buoy their confidence in the industry.
Yeah, it's interesting. The distinction here is that there are always in real estate cycles, and the market always goes down and people always lose money. I mean, it just happens, right? There are those that have been through it before and lost money really understand how to insulate themselves the next time. It's a painful lesson that investors unfortunately tend to have to make in order to be more effective investing going forwards. The distinction here is it's not really, well, the real estate cycle is what's hit it, but what you've uncovered is a misunderstanding on the part of investors what it was they were actually investing in and actually what their rights were. And it's in the bankruptcy become clear that it's actually really complicated in this particular case to understand.
Definitely. And actually, I want to make a clarification too, because, and something that you definitely know and your readers might know, that issue is mostly in the world of debt real estate, debt crowdfunding, because of the way that notes are basically created. I mean, at a certain level, you can't have 500 people's name on a title for a mortgage. So there are real reasons why. I don't want to insinuate that this is like some, shadowy plan to, pull the rug away from people.
Mm-hmm.
But there are a lot of debt platforms out there, and a lot of the marketing and frankly the PR, which is essentially marketing for journalists, that is out there is, makes it seem as if people in these situations are buying a piece of real estate. Like, I think that was, I have the article in front of me. I'm pretty sure, I don't want to misquote Mr. Burry, but he said, sorry, in a press release, Peerstreet's notes are backed by real estate. And these people, they are backed by real estate in a way, but also not really in the same way that people think they are. So that kind of delta between the marketing and the fine print has been unveiled here.
Yeah, and that's really the nuance here with Peerstreet. Investors, and again, if you don't mind, if we kind of drift off into general most real estate, I'm interested to hear your view. Investors don't really. I mean, I've been studying offering documents for private equity placements, Reg D 506C offerings. There's a lot of turbulence in commercial real estate at the moment, as you well know, because of price resetting and interest rates and et cetera. And you don't really, although terms that cover the worst case scenario are primarily are the primary reason that anybody puts together offering documents in the first place. Here's what you're getting. And then there's this huge section on what happens when it goes bad. Nobody really focuses on that until it does go bad. And then you pull out your contracts, dust them off, right? And that's when you suddenly realize that, the rights, that you suddenly acknowledge what rights you have, more relevantly actually don't have. But you don't really think about it. You don't internalize that until you actually are facing it. And that's really what happened with these guys.
No, I definitely agree. And I think, again, not to be too much of a pop psychologist, but I think a lot of people, when you get into investing, especially like this kind of investing, which kind of has there's like an entrepreneurial element to it. And even though you're not really an entrepreneur, but it can feel that way compared to like, parking your money in a REIT doesn't really feel like you're an entrepreneur. But there's an optimism inherent in investing, and I think all of us, I don't do individual investments. I think ethically as a journalist, it's a little challenging. I mean, you can, but also, I mostly invest through kind of, mutual funds, et cetera. Right. But I think whenever you're investing, there is an optimism that you're going to get, maybe at the best case scenario, but one of the better scenarios. And obviously, everyone knows there's downside risk. Everyone knows there's ups and there's downs. And everyone, people who have been through cycles are much more well prepared for that, for sure. But I think, there is that glimmer of optimism for all of us, especially on like an individual level. And, you see it in some of the underwriting for kind of multifamily, which, multifamily obviously was had a huge couple of years during the pandemic. Because for a lot of reasons and a lot of valid reasons, but there was kind of an optimism that rent growth would continue at 10% a year. So a lot of these loans that, these multifamily operators were getting assumed this kind of level of rent growth, which, like, frankly, as a renter, like I'm kind of like, what are you guys like? You guys probably haven't rented in a while. If you think people are going to put up with 10%, if there's space for 10% rent increases a year for 5 years, I think you might be, that's the crude, but like, what are you smoking, guys? But regardless, that's just my own personal thoughts there. But I think, unfortunately, we're at that period where that optimism is hitting into the wall of 0%
of realism. You're right. It's hitting the wall of realism. But exactly. Actually, multifamily is an entirely different topic, and I do want to just chat with you briefly after the podcast, sure, if you don't mind. There's some stuff actually going on that I wanted to ask you about, but separately. So I'm just going to share with you a little insight that I have about what may have underpinned Peerstreet's. Part of what underpinned Peerstreet's collapse, along with all the other things that we've been talking about, kind of misalignment of interest and type of capital that they got, et cetera, and underwriting standards, et cetera. So one of the first conversations I had when I started podcasting, however long ago it was with a professor, a fellow called Charlie Nathanson. He was at Northwestern University, and he did a study on house prices and whether or not you're in a bubble. How do you know you're in a bubble? And the way that what he concluded was this idea that as the housing market gets longer in the tooth, right, as the growth gets more and more, what you see happening. And of course, there are a lot of other factors as well, Alex. It's not just this one. But what he saw was the number of fix and flippers. And he analyzed it by the amount of homes. He looked at the period between buying and selling, right? So was it 1 year or 2 years? If it's that, he assumed these were fix and flippers. He saw that increased as a proportion of the market. And I've not looked at the data, actually. I've just been thinking about this recently, would like to dig it up. The proportion of people fix and flipping increased dramatically, and then suddenly dropped off. And it drops off, and what happens is that prices continue to rise, and then they drop off. And that actually is what I think's happened here. As interest rates started to go up, what happened was prices started to flatten, right? And as a fix and flipper, you have to assume that prices will continue to go up in order to justify buying a house, putting money into it, and then selling it in a year or two. You have to assume that past performance is indicative of future performance. And as soon as you realize that is not what's happening, they drop out of the market. So now you have this kind of foundational demand driver falling out of the market. I don't know if that's what happened here, but I imagine that was probably part of because all of Peerstreet's capital investments were with fix and flippers who are suddenly hit now by a ceiling of non-increasing or not as rapidly increasing house prices.
So a couple thoughts there, because that's fascinating. I'm going to have to read that study and maybe reach out to Charlie. I appreciate that.
I'll send you a link actually to the podcast.
Would love that. Yeah. Love to check that out. But an example there from the Peerstreet bankruptcy, and then if you'll indulge me, I have an example that's related, but
sure.
In the world like Zillow and Zillow offers, I could talk about for a second because I think that actually is kind of connected. So in 2021. Peerstreet originated $695 million in mortgages. In 2020, as of June 26th, when it filed. So it filed in June. That's a lot. Well, anyways, 5.4 million in mortgage origination. So that is a collapse of hundreds, maybe even thousands of percent. Yeah, that's a lot. A lot percent. But clearly that's happening here. But I think the other thing so I covered the Zillow offers situation very closely. Zillow offers is basically an institutional, one of these institutional fix and flippers. They call them iBuyers. Open Door is kind of the biggest one around, and they've had, quite a rough go of it. But when Zillow, I kind of feel like the Zillow offers was a bit of the canary in the coal mine, maybe, for this exact thing you're talking about, where Zillow was, they have so much money, obviously. They're a fabulously wealthy company, and they have a lot of money to invest. And they were invested in growing at all costs. And we actually broke a story about, in 2021, they had this initiative called Project Catch-Up, which was kind of a grow at all costs, flip as many catch up, like as in the condiment, but also catch up to Open Door. And they were trying to, basically, they were fine with not getting great margins. They just wanted to flip as fast as possible and try to catch up to the level of flipping that Open Door was doing, who's the leader in the industry. And then suddenly they stopped, and it was a huge news story. The company stock tanked. They closed that industry, or that business line, and they got a lot of, heat for it. And what's kind of funny is now, when you look at it, it actually seems like they actually maybe saw what was happening earlier than many others did. This kind of, obviously there's the stuff about trying to grow too fast, et cetera, but they might have seen that the fix and flip market, the top was coming and it might be time to get out of this.
Yeah.
And they left, and I think in a lot of ways they actually look quite smart in retrospect 2 years later, even though it was quite a bumpy exit because of that. And I think it's a really fascinating kind of narrative, and I think we're definitely seeing that play out. I would love to see the numbers myself, but yeah, I really appreciate that.
Yeah, I'm actually personally in the market to buy another house, and it's just mind numbing. The challenge that I have is, wanting to buy something now, but also not wanting to buy at the absolute peak when one has to believe that there is something artificial propping up the housing market. It's a whole different topic, right? You're not wanting to sell at a sub 3 mortgage to buy into a 7+ mortgage, freezing up the market. I think Mohammed El Arian at Oxford University opined about this just last week, this exact topic, but it's a bigger subject. Alex, thank you so much. I hate to wrap up, but I'm going to have to wrap up. We've been talking for quite a long time, actually. It's gone very, very quick. I would definitely like to talk to you about multifamily and share some ideas with you. But for today, thank you. I really appreciate you taking the effort to get sign off on joining me and for joining me. It's a real pleasure. I enjoyed your article. It was, as I said, exceptionally well researched. I'm a historian, a PhD, a historian, right? So I really appreciate
wonderful,
and diving into this kind of thing. So I'm grateful for that article and also for appearing on my podcast today. Thanks for joining me, Alex.
Thank you so much. This is such a pleasure. And as you said, it went by so quickly. I feel like we have so much more to talk about. So looking forward to staying in touch. And just thank you so much for this opportunity and for sharing my article with all of your listeners. Such a pleasure.
All right. That was Alex Nicoll, reporter at Insider, talking about his article, Real Estate Crowdfunding is a House of Cards. Oh, my goodness. I still can't get over that headline, which he does confess, as you heard, is a little clickbaity. But I hope you found the conversation enlightening. Sorry about the sound quality; it wasn't absolutely perfect, but sometimes you got to look through that and understand that the words spoken are more important than the quality of the mic being used. What can I say? Thank you so much, Alex. I really do appreciate it. I said it a couple of times in the podcast. Really do appreciate you went out of your way to sign off to join me today. It was a pleasure to meet you, and I do look forward to talking to you more about how the global financial crisis or what happened during the GFC seems to be repeating itself today in commercial real estate. Of course, the GFC was residential. So I look forward to talking to you about that. Maybe we'll have another conversation at some later date. And of course, to you two, dear viewers, thank you so much for joining us. Appreciate you spending the time. And that's it, actually, for today. I will see you in the next episode. And for now, this is Adam Gower signing off.